So we had some improvement in the internals. It's not, the best, but it's much improved. It leads us to suspect that we're on our seasonal rally mode. We had some nice breakouts by both small caps and mid caps that lead us to, anticipate a decent run here. And if it broadens, if it gets better, we could have a very nice run. So we can see our supply and demand curves have had some reaction. The demand curve is the one where we have the biggest reaction. It's risen above its 40 DMA last month and this month, breaking out above its downtrend line, shows the most strength. And that's actually what you'd like to see in a rally, is that the demand curve is among the strongest. The supply curve it's below its 40 DMA, but it hasn't really broken a prior low or broken its uptrend line. So we'd like to see that develop. And the spread, which is kind of what you watch really most closely because it's the net of the two, it's above its 40 DMA and it's showing some decent strength, but it hasn't broken this sort of key level of its 200 DMA and this downtrend line. We'd really like to see that develop clearly before we get really all out aggressive. What I would say is we would get more aggressive here. We would definitely focus on the very strongest sectors and themes. And if we can break out further and add to that, then you can sort of broaden your bullishness. But another thing to watch, just kind of as a long-term thing here, this is kind of the volatility environment in the 1999 to 2000 peak that came out of that 1998 correction. And we're starting to see potential glimpses of a higher volatility environment where volatility is not really declining as the market goes higher and option volatility is increasing. So if we get that for many months more, that's when you start to think that you're building for kind of a potential major mania peak top. So just keep that in the back of your mind. If we run nicely here and this volatility environment changes, that's a kind of a warning sign. We've had very nice breakouts in the value line, which is sort of one of the broadest indexes, although it's smaller cap weighted. The mid caps broke out first, so that's kind of where the best relative strength among the new breakouts is. But the fact that both of these are breaking out shows that participation is broadening very nicely, as you'd want to see. And then, of course, really recently we've had even the small caps breaking out. All of these are after multi-month consolidations. So really, in the small caps and mid caps, we've kind of gone sideways to correction and had double-digit corrections really since February, March, April. And so now we've had this long, prolonged trading range. Now they're all breaking out higher. Very positive sign. What is pending, though, and a few things we'd still like to see are we'll talk about. We can also see in the broad niche that it is showing better participation. So this is the percentage of niche stocks above 50 DMA. These fell to very kind of oversold levels, retested the lows, kind of where the trading range are now breaking out, breaking prior highs, and breaking above a downtrend line in positive fashion. It shows that participation is increasing, which you'd like to see on a sustainable rally. And of course, we've talked about the seasonality. Seasonality, we're really kind of suggesting that maybe a mid to late October low and rally would develop, and that's typical seasonal. Certainly between October and December, you're very likely to get a low, but it looks now like we've got enough participation, enough breadth, enough things developing. We can say this late October low is developing and the market's sort of behaving along this typical seasonal. So that's kind of what you have for the typical seasonal, and we're kind of looking like internals are confirming that it's likely to develop. Realize that strong November is the second strongest month of the year besides April, although it's the most reliably strongest month of the year. 80% of of November's the last 20 years have been higher. You typically get this really strong early period, which we've had. Then you get sort of some kind of consolidation or correction for a week or two. And then the latter part of November is also very strong. Then the way things are materializing, it looks like this pattern could repeat. So just keep it in the back of your mind from a broad market perspective. Some of the things that aren't happening, there's a lot of internal things. We're not getting a lot of breadth thrust. We didn't get the classic capitulation and then demand response that we'd like to see. So we can't really redo that. But what we'd like to see is we'd like to see the Nice-McClellan oscillator get clearly above 150. It's inched above it just by fractions of an inch, just barely in single digits above that a couple times. We'd like to see those highs broken in really clearly into the 150, 160, 170 range at least. We'd also like to see the Nice-McClellan ratio adjusted summation index rise above plus 500, which typically happens in rallies that are sustainable. And when that happens, you usually don't get a peak until this declines back below 500 and you're making new highs and you start to get divergences building. So this is something we'd really like to see in both of these McClellan series that would confirm a more sustainable rally mode. We'd also like to see the breakouts and relative strength by both small and mid caps, which we'll look at. And then to get to a sort of a fifth gear running, we'd really like to see the IBD 50 start to show a clear intermediate term uptrend in relative strength. So small caps and mid caps are close to at least breaking out of a base on a relative strength basis, broken the down trend line, but we want to see a trend higher. And ideally, we'd like to see that pick up steam. And of course, small caps are still lagging the mid caps. We'd like to see these break through the October highs before we pick up another notch in terms of being aggressive and participating in this upside rally. And then really just, to get to where we'd really like it, we'd like to see this point and figure chart of the relative strength of the IBD 50 versus the S&P break out on an intermediate term basis. That would likely be, that's when we tend to get sort of when our lists really substantially outperform and you can really make a lot of money. So we'll watch for that. It looks like it's not developing yet, but it can certainly develop in the later phases of the rally. The other thing to realize about this rally is it's global. Starting to see better participation on the upside in foreign stocks, although they're still lagging. And the strange thing is, we've kind of been waiting for foreign stocks to show relative strength, but what we're getting instead is the U.S. breaking out in relative strength terms versus the global markets again. So you still want to be participating mostly in the U.S. strongest sectors because that's where the relative strength is. And then same thing, a lot of people are talking about, okay, if the economy picks up again, we get a reacceleration, get some comeback by value. But what we're seeing, again, sort of head and shoulder bottoms. This is sort of really a head and shoulder consolidation, but it has the same message. And head and shoulder bottom in growth versus value. So we're seeing a breakout by growth and a breakout by the U.S. So those are the things that you want to favor. So as our top relative strength sectors, we've got, our list there, and take a look at those. A lot of those doing well. We have some sort of a combination of things. Got some that have been doing very well and already broken out, like semiconductors and energy and that we talked about in the last Reed's report. Now we're starting to see a lot of that list broaden. So we've got a list of top relative strength, and we've also got a list of recent breakouts. Now, the recent breakouts tend to be the ones that hold up if you get a short-term correction. So you might want to mix some of those with the very strong relative strength. So we've got recent breakouts in industrials and small cap industrials, in small caps and mid caps. Semis have really been leading for a long time. Retail's broken out. Autos, Cars is a nice ETF because it has some of the electric, some of the robo cars that are performing well. Alternative energy was another sector we mentioned last time that's done very well. Lithium broke out earlier. Banks, of course, were kind of the main. Financials have been doing very well for a long time. Recent breakouts in transports, in cyber and cloud, and in different industrials, and then in robotics, which I really like to play the recovery. And then robotics and infrastructure plays sort of had some nice breakouts, and those are things kind of in anticipation of this bill that just passed, infrastructure. And our stock list, again, we have super ton of members on our long list and on our short list. So there's still a little bit of this two-way backdrop. If you're a short-term trader, you still probably want to have some shorts until the short list really comes down to size. And it's not yet. It's still both of those lists. If we did all the stocks that met all the criteria, we would have hundreds of stocks on both of those lists. We try to cut it down and have the best ones and have, something like 75 to, or below. So this is our list in our top 20. And again, we're watching these guys for breakouts. We're watching, good runaway moves. We had, last time we talked about buying Wall and MTDR. Those both have done well. And TPYP, all three of those have done well. Just use trailing stocks and let those positions run. On this list, we have a smaller grouping of potential bases because a lot of these have already broken out. But here those are, so you can certainly look to buy some of those. And the strongest plurality, the sectors where we've really emphasized now for this sort of third gear bullish environment, include finance, semiconductors, software, transports, chemicals, energies, alt energies, and then some of the recent breakouts, including small and mid caps, retail, and industrials. Some of the things that people are asking, okay, why are we now breaking out? The bullish factors really are growth is reaccelerating. We can even see it in the labor market, strength starting to materialize. But it isn't reaccelerating so sharply that it's going to invoke faster tightening by the Fed or other central banks. PCE inflation has been down month over month for 5 months in a row, providing proof that the central banks are saying that inflation is transitory, even if some of these supply constraints mean that the higher inflation is going to be around for longer than they really thought. Pretty much globally concerted central bank expectations that inflation is going to be longer, but it's still going to be transitory. I think the key one there is even the Bank of England didn't tighten when it was expected to because it's worried about the weak side more than it is about inflation. Tapering, the pace of tapering announced by Powell predictably was on the low end of expectations. Of course, Powell is looking to try to get reappointed, so he doesn't want to step on any toes. He was the most dovish I've heard him at a press conference, really did a good job of dampening expectations of tightening. He talked about how inflation is still transitory. He talked about how the pace of tapering will change and adjust, but they want to take it really easy and not tighten too much. And also talked about that when tapering ends has nothing to do when they actually start to raise interest rates. The emphasis being we're cutting down on the stimulus going into the markets, but we're not anywhere near ready to tighten. The other thing, the Delta variant case growth is falling sharply in the U.S. and globally outside of a few regions. Germany is at, and some areas in Asia still have some problems there. And of course, we have winter coming up, but we also have these new pills from Pfizer and Merck that look to be hugely effective at, if you do get the virus, keeping the hospitals, keeping you out of hospitalization and making it more like a normal flu. So I think that combination really is going to help keep the recovery alive. We just had the U.S. infrastructure stimulus bill passed, and because of the way the Democrats decided to not do any negotiations with the Republicans and pass things on their own, even though they have a really narrow majority, what has happened is the one or two Democrats that don't like the massive spending and the huge historic tax hikes that were being proposed have said, no, we're not going to vote for this unless you bring it down to size. We're not going to vote for tax increases in the next year. That's a very positive surprise for the market. That's a really big deal. And then another big deal that's happening is that two courts now have ruled that Biden's vaccination mandate and forcing companies to essentially get rid of labor or labor to quit that hasn't taken the vaccine is unconstitutional. And so there were a lot of concerns about, we already have a labor shortage. Having a lot of people have to quit or leave or change jobs because of that vaccine mandate was a real problem, and it's looking like that's not going to be required, and the courts are going to knock that down. So those are all reasons why we've got this bullish shift.